China's global playbook is evolving to keep its competitive edge. A decade ago, companies began diversifying production beyond China into lower-cost countries like Vietnam, Cambodia, and Mexico. That shift became known as China Plus One. But as supply chains became more complex and global risks harder to predict, that model evolved into something bigger. China Plus Many, a network of production spread across multiple countries, designed to improve resilience. And that strategy continues to evolve, becoming less about where goods are made and more about where companies are managed, financed, and scaled.
It started 2018 with the first Trump administration. Back then, companies were scrambling for solutions. This intensified during COVID.
Rising labor costs, geopolitical tensions, and uncertainty around US-China tariffs have forced companies to rethink their supply chains. But diversification has its limits.
Many of the input materials still come from China, or the components, they're just assembled somewhere else. A good example here is Apple. Apple has diversified its supply chains, it's manufacturing its products in Vietnam and now also India. And then tariffs were levied on a lot of other countries. Tariffs on Vietnam were quite high just last year.
As tariffs and trade pressures spread beyond China, supply chain risks were no longer contained to a single country.
What we have seen now as part of the Trump administration in the second term, and more globally, that companies are realizing, including Chinese companies, the shock can come from many different directions. So maybe a China Plus One in the traditional sense is not the strategy to go.
In response, China is reworking its strategy, and that's pulling it closer to a long-standing partner, Singapore.
Singapore plays a very, very important role because Singapore has the ability to sit at a table with Washington and Beijing without being seen as favoring either or. They are neutral. In your Asia strategy, if you do not have Singapore in there, then I would question whether you have the right setup. You need the country as your control tower in the region. Everyone can do business here, and this is something very important to Chinese companies and Chinese investment. When you look at the fixed asset investment into Singapore, the Chinese fixed asset investment rose from 2.5% in 2024 to 20.6% in 2025, right? That's an 8-fold increase. At the same time, American investment went back.
China has been Singapore's largest trading partner since 2013. Under their free trade agreement, 95% of Singapore's exports to China are tariff-free. The relationship runs both ways. Singapore became China's largest source of newly committed foreign investment in 2022, overtaking Japan. In 2024, Singapore invested around $10.7 billion into China, while Chinese firms invested nearly $11.8 billion into Singapore.
Singapore is sort of like the first stop to explore the broader Asian market. It can be from the very simple things of the rule of law in Singapore, governance, where Chinese companies are realizing that if we want to be competitive globally, it's actually an asset in terms of corporate strategy, treasury functions, and also as a platform to raise capital.
It is a safe place to have your investments and deploy them from here into other markets in the region. This is why Singapore is the largest investor in countries like Vietnam, India. All this investment comes here from Singapore, but it doesn't come necessarily from Singaporean companies, but from MMCs headquartered here.
Today, around 8,500 Chinese enterprises operate in Singapore. Early waves of investment focused on trade and infrastructure, but the latest wave is different. It's increasingly driven by tech companies drawn by Singapore's AI ambitions, deep talent pool, and access to global capital. Chinese tech giants like Huawei, Tencent, and Alibaba have established R&D centers here, while firms like ByteDance, Shein, and Manus AI have shifted their international operations to Singapore to access global funding and recruit beyond China's borders. The timing is no coincidence. Southeast Asia's fast-growing middle class, spanning close to 700 million people across Indonesia, Malaysia, Vietnam, and beyond, is becoming one of the world's most coveted consumer markets.
Singapore is an important center for finance and growth in Southeast Asia. If you pursue a multi-market expansion strategy, then this needs to be coordinated from here.
Think about the size of Indonesia and Malaysia combined. Of course, you could export everything to this part of the world, but China understands that is not sustainable. At the end of the day, you need to have localized production.
As global markets fragment, China isn't stepping back. It's adapting by doubling down on self-reliance while remaining integrated with the global economy.
Investment into China doesn't just come from Europe or the United States. We see investment from Southeast Asia into China, from the Gulf and the Middle East, from South America.
China still is the anchor for the value chains. China now is competing head-on in areas where Europe, traditionally speaking, was the leader. In the past, what we saw technology transfer from the West to the East, right? So the question now is, can we see technology transfer from the East to the West?